Welcome to the B.F. Anderson Techno Fundamental Report for August 29th. Investment strategy, in my opinion, is the most important skill an investor can develop over time. Now, I'm going to tell you about my experiences because I believe, I'm going on 49 years of doing this professionally. And, I started out as a young boy actually investing with my grandfather. But, you have the conscious mind and you have the subconscious mind. And the subconscious mind is important because over the years, you're going to develop your strategy based on your experiences. And so the key to a strategy is that you need to basically understand no strategy is going to work all the time, because if it did work all the time, then everybody would do it and then it wouldn't work. Point being is, once you've developed your strategy, you really need to stick with it. So as you can see here, I've got a graph here of the Dow Jones Industrial Average going back to 1900. Now let's talk about primarily two strategies. One would be S&P 500 index fund type strategy, and then the other would be the strategy we use, which is called focus investing, along with trend following. We're trend followers and we're also focused. Now, as an indexer, let's just say you plunked your money in around here in 1928, 1929, when things were red hot. It took you 27 years to get back to where this level was. Now, that strategy, if it's coupled with dollar cost averaging, and this is pretty much true with any broad-based mutual fund type strategy, and back in these days, they really didn't even have mutual funds. But if you dollar cost averaged, and you can kind of see here around 1934, 1935, the market started to turn up. Now, this is where my dad started buying Standard Oil of New Jersey. Now, Grandpa, he bought New York Central. Now, my grandfather was from Colorado Springs, and he would come live with us in the summers and in the winters, and then go back to Colorado in the summers. He was a railroad man. He was a financial officer for the Colorado Southern Pacific, and he really loved the railroad. He loved riding on the railroad. He loved everything about the railroad. So his primary investment was this company right here, New York Central. They went bankrupt in 1970. The rail industry, passenger rail industry, just kind of went down the tubes. The point I'm making here is that a buy and hold strategy is a good strategy for some people, not for me, if you diversify. Now, the problem is that sometimes it works and sometimes it doesn't work. So, when I was a young boy, Grandpa came to Baton Rouge and was staying with us, and every day we would, in the afternoon, we would get on his bed in his bedroom, and we'd open up the Wall Street Journal and look at stock prices. And so one day, Grandpa said, "Hey, when you were born, I bought you a life insurance policy, and it has a cash value, and we can cash it in, and you can spend the money, or you can invest the money, whatever you want to do." And I said, "Let's go invest the money." So we went downtown Baton Rouge to his broker, and they convinced me to buy Gulf States Utilities, which I did. Well, it didn't work out too well. Riverbend came along, and they had a $1.4 billion cost overrun. The company was basically bankrupt, and they had to sell out to Energy, which is Energy today. Now Dad, and here's John D. Rockefeller. Dad was with Exxon. He started with them in 1933. So this buy and hold worked out fine. Standard Oil worked out real well. So all of this kind of got me going in this direction, really helped me quite a bit about reading about these things. And, we all know who Warren Buffett is, and this book called The Warren Buffett Way, written by Robert Hagstrom. In the beginning, he says, "Robert, we just focus on a few outstanding companies. We're focused investors." So the point he's making is that you really need to be a know-something investor. You need to learn about your companies. You need to understand their products, understand their services, basically understand the business plan. That's, to me, the most important. So, Buffett just basically says, never just buy and hold. But, he made his money as a focused investor. He did not make his money as an index investor. He started out with Geico and then he moved on to Coca-Cola, then he moved on to Apple, and he just knew what he was doing. But it wasn't just blind buy and hold, because he knows the dangers of that. Buy and hold can be extremely dangerous, especially if it's New York Central Railroad. Now, this book here, this is a very good book. I recommend it highly. It's The Psychology of Money. Most public companies are duds. A few do well, and a handful become extraordinary winners. That account for the majority of the stock market's returns. So the name of the game is to find those winners. Now, you need to find them early. You get these companies that are now, $1 trillion, $2 trillion, $3 trillion. They get so big, it's like pushing on a string. You just really have to realize that the mathematics on these large companies, sometimes they work, sometimes they don't. But I prefer to find companies that are, the smaller of the group after I've done my evaluation. Now let's just take a look at the market. We can see here the NASDAQ's kind of rolling over here a little bit. Not too bad. We're still basically, the primary trend is still up. This just looks like a correction right now, but just be aware of the fact that things kind of need to stabilize. We got some nice moves in here. It would be nice to see us kind of just stabilize in here and then break out of that base. Now here's the S&P 500, kind of the same thing, a little bit of a rollover. Looks like a correction. It doesn't look like the beginning of a bear market because, as long as the primary trend stays up, you have to view these pullbacks as corrections. This is the 200-day moving average. This is a very important level. And so far, we've been able to hold up above this 200-day. Now, this was the big pullback. We held, and, we're starting to rally in here. We're getting a correction, but we're holding the trend. So that's good. Now, I did want to mention what's kind of going on in this market right now that's the problem for guys like me and other people. The smaller companies are pretty much measured by the Value Line Geometric Index. This is a 1,700 stock index that's equally weighted. It's not market cap weighted. But you can see here this index peaked back in 2022, or 21, excuse me. And it really hadn't gone anywhere for a long time. Now, we're hoping this is going to change, and if it does, we think that hopefully lower interest rates will kind of trigger. But the small stocks, the mid-sized stocks, are definitely underperforming. We all know about the Magnificent Seven. The market's been driven by approximately 7 stocks. Now, this is a concern. I have to say, this is my greatest worry right now. This is a ratio that I do called the aggression index. It's where I'm taking basically technology stocks in the form of NASDAQ, and I'm dividing them by consumer staples, which are basic needs. When mutual funds or hedge funds start moving their money around into the defensive areas, you're going to see it in this ratio. Now, you can see here what's happened here back in, when I showed you the geometric index peaking. This was also peaking. And you can see that it broke down and really had a tough time. That was a bear market of 2022. Market dropped pretty drastically. We're starting to see some kind of early troubling signs here. We broke below the moving average, then we rallied, and then we're pulling back down again. It's very important, I believe, that we hold this level here. If we start breaking down into here, you can see what happened last time. No guarantees of any kind, just letting you know, keep an eye on the aggression index is probably a good thing to be watching right now. New lows, good sign there. This is some good news. We're getting not a whole lot of new lows on the New York Stock Exchange, which kind of is an indicator we use to determine if the selling is drying up. It doesn't look like we're in a serious situation like a bear market or anything. We just continue to think this is a correction. Now, NVIDIA reported last night. Let me see how it's trading this morning because I wanted to see what's going on. Let's see. Right now, it's about 121 approximately. So that pulls it down to right about here. That's just not a bad thing. But it would be nice to see it break out above 135 on heavy volume. The only problem I've been seeing here is that as it did rally recently, it did it on fairly low volume. It wasn't a robust rally. And then we've stabilized here, waiting for the earnings report. Earnings report, the reaction has not been positive, but it hasn't been extremely negative either. So if you have any questions, please let me know. Thank you very much.